In this video, I want to look at signs that a firm could be heading for a bit of a cash flow crisis. Now, there are different ways you can do this, but in this video, I want to focus specifically on three aspects of a firm's cash flow statement that could point to trouble ahead. It's not a video for accountants, so I'm going to keep the stuff on cash flow statements fairly brief, get you to the warning signs. So with no more ado, profit and cash are not the same thing. All right? You shouldn't look for necessarily the same story in a firm's profit and loss account as you get when you look at a cash flow statement or indeed a balance sheet. Now, there are plenty of ways I could illustrate this and use a very simple one. Imagine a firm has sales of 100 million. Purchases, which I'll assume for the purposes is a very simple example, that's cost of sales, are 80 million. The gross profit, all right, well, if you've seen my video, what is profit? All about which profit figure you can trust and how to use them, you'll know that all you do is compare the sales figure to the purchases or cost of sales figure. So gross profit is simply the difference of 20 million. And on that basis, you might think all is well. That's for one period, £20 million profit. Now we turn our attention to the way these sales and purchases are being made. Are they being made for cash? Are they being made on credit? And let's assume this is a small business, so let's introduce some credit terms. So 75% of sales for this one period are made on credit. Now that's because it's a small firm. Customers expect to take a bit of time to pay us. So only 25% of sales, if you want to turn that on its head, are for cash. And 25% of purchases, all right, are made on credit, meaning 75% of purchases are made for cash. And if you think that's a bit extreme, then you probably haven't run a small business where those sorts of credit terms are very typical. Suppliers tend to squeeze us because they don't trust us necessarily to pay, as do customers. They take lots of credit. Now, what would that mean in cash flow terms? Well, if you translate that, if 3/4 of sales are on credit and only 25% of those 100 million sales are for cash, then the positive bit of cash flow, if you like, is only 25% of that 100 million or 25 million. And the bad news is 25% of purchases on credit, so 3/4 of the 80 million, that's 60 million, are made for cash. So going out the door on purchases is 60 million, and the rather bad news there is that that leaves us negative, down, all right, to the tune of 25 minus that 60 million or 35 million. Now, a bit of scribbling there, but basically we're saying we are cash flow negative to the tune of 35 million with a gross profit of 20 million. So that tells you two things. One, profit isn't cash. And two, if this business carries on trading like this, they're going to hit a cash flow crisis fairly quickly. All right, now it's only one period, only a snapshot, but you get the idea. So, cash and profit, two different things. Right, cash is king. A lot of people think cash is king. I don't 100% agree. I think you need to look at the profit and loss account, the balance sheet and the cash flow statement. They give you different messages, but why do people say cash is king? It's kind of a cliche. Well, profit and cash are not the same thing, and of the two, cash is seen as the less subjective. We don't do things like buy assets, decide how long they're going to last, and then write off a proportion of their costs. It's called depreciation, amortization. It's all rather confusing. Cash is a hard number. You've either received it or you've paid it by the end of the year. So a lot of people think if you're in doubt about profits, look at cash flow. And I do agree with that. So where can you look in a cash flow statement for trouble? Right now, to run you through the bare bones of a cash flow statement and then 3 red flags, other videos will take this on in more detail. A cash flow statement simply says, if you look at a business for a 12-month period and you look at its cash flows, you can divide them into 3 distinct sections. Number 1, the cash flow, hopefully positive, from operations. That's the heart of the business. Without going through every single subheading, cash flow statements are quite a big page in the accounts. That is the cash hopefully generated by a business's day-to-day trading operations, hence the title. But that's not all businesses do. Don't forget there are investing activities. So cash gets spent buying fixed assets get sold, other businesses get bought and get sold. The cash flow generated or absorbed by those activities goes into a separate section, okay, which also covers 1 or 2 other bits and pieces. And then down the bottom, you've got the cash flow from financing activities. That's where you get the cash in or out for the 12-month period you're looking at, let's say, that relates to issuing shares, that brings cash in. Okay, issuing debt brings cash in. Buying back shares sends cash out the door. Paying back loans, buying off debt, that sends cash out the door. So 3 discrete sections, and that's all I'm going to cover in this video to make the points that are coming up next, the kind of warning signs that all may not be well. Here they come. So, snapshot of a cash flow statement. What are you looking for potentially? Here it goes. 3 red flags. There are more, but here are 3. First of all, overall cash flow is negative. What do I mean by that? What I mean is, down the bottom, the overall change in a firm's cash flow for the period you're looking at, that's that number there, combining all 3 sections of the cash flow statement is negative. That's bad, but even worse is when you come up to the top and that number's negative. So the heart of the business's operations is sucking cash, absorbing cash, not generating it. If you're looking at a Tesco, for example, you should be seeing cash being generated from its core operations, not being sucked in. So what I've put is overall cash flow negative, not ideal. Operating cash flow negative, that is an instant crikey, what's happening here? Why aren't they making any money? They'll have a story. You know, if they're back before the days of the dot-com boom and bust, companies were saying, well, we have to absorb cash to grow, blah, blah, blah. But essentially, you need to have a story there. Number 2, operating profit is not covered by operating cash flow, or there's no relationship between the two. So let's assume that the number at the top is positive, at least. What you want to see is some sort of relationship between a firm's operating profit in the profit and loss account and cash flow. You want to see profit being converted into cash. All right, it's called cash cover sometimes, give it a flash title that analysts like. You want to see some relationship. Firms like Enron, before they went belly up, you know, cash flow all over the place, no resemblance or relationship between what's going on in the profit and loss account, what's going on in the cash flow statement. It's all very well the director saying, well, we're a complex business and you can't just look for these simple relationships. Well, my view is, if it's that complex, I don't understand it, move on, okay? Cash from financing activities not being applied to investing activities. What I mean here is, like an individual, short-term cash pays for short-term assets. So your bank overdraft, for example, isn't going to fund your house. It might fund your day-to-day living costs. Same with companies, long-term financing like a mortgage pays for your house. Long-term debt issues, share-raising activity is to pay for investment in the business. So you want short-term financing matching short-term assets, long-term matching long-term. And if you see a mismatch, so you see a firm raising lots of share capital and seemingly losing it in operating activities, that's not sustainable, all right? So in essence, to go back, I'd be looking, and there's some subheadings in here, for some story that makes sense in those 2 sections of the cash flow statement, all right? So there you have it, 3, only 3 quite big red flags. Not a disaster sign if you see all 3, but certainly beg lots of questions, and certainly you've got to be looking at a company and thinking, okay, with that many warning signs flashing at me, am I sure that management have got cash flow under control? That was quite quick. Any questions? The usual, editor@killick.com.